Okay. Good evening, everyone. How are you all? Doing good. So I welcome you back to the evening session of our CA Inter class. Today we are going to continue with the subject of financial management, and we'll take up a new topic, as you can see on the screen, which is about the ratio analysis. Right. So we can see there's Bhumika, there's Krishna, Kiran, Malay, Tushar, Darshan, and many more other smart students. Okay. So we'll be beginning with this chapter of ratio analysis, guys. It's going to be a practical chapter wherein we'll be solving a good number of questions along with a great degree of conceptual clarity. Okay. So uh, we'll do certain concepts initially and then we'll go for the questions to be solved. Now, meanwhile, when we are discussing this ratio analysis, you may find that a lot of numericals or a lot of formulas are coming up, but you need not worry because those formulae are ultimately logical, and try to remember those formula with logical sense and not just mug it up. Okay, fine. So we'll begin with ratio analysis, but before that, there's a query from Darshan. Sir, what are callable and puttable bonds? Darshan, callable bonds are basically those bonds which can be redeemed before the due date by the issuer. That is, the company can call back the bond and repay the principal and close the bond or cancel the bond before due date. So when the company has the option to cancel the bond before due date, that's the callable. When I, as an investor, the holder of the bond, has the option to redeem it before due date, that's the puttable bond. I hope I have answered your query, Darshan. Okay, Bhumika, what's the income note? Income note is basically normal debenture, you can say, Bhumika. Yep, fine. So let's go ahead with the ratio analysis. Yeah. Uh, I'll take up the queries probably in the last part of our today's session. So right now, I just not so just reserve your queries, whatever you have with regards to the sources of finance. I'll discuss that definitely, but after I can say in the end of our session. Okay. So let's begin with the ratio analysis right now. Okay. Now, my basic question to you is, what factors to be considered while deciding what factors are to be considered while deciding which company to invest? So I'm asking you, what all factors will you consider when you're going to decide which company I should be investing in? Now, investment in a sense that you are thinking of giving some loan to the company, right? Giving loan to the company, or maybe getting the equity shares of the company, right? So when we are talking of this uh, investment, you're talking of both the ways. That is, you want to buy the debentures of that company, or you want to buy the shares of that company, or make an equity investment into the company. So what all factors are you going to consider? Okay, let me see the answers. Uh, okay, profit earning ratio, financing, investing, dividend. Okay, profitability and its debt, good amount of cash, profit, liquid ratio, return on investment, company's credibility. Okay, anything else, guys? Anything else that you can think of? Okay, capital debt ratio, return on investment. Previous year and current year performance of company. Okay. How is the cash flow, earnings per share? Okay. Company's performance, profit wise, net worth. Okay. Okay. So some of the factors that you have listed, let me just note it down. Some of you are talking of return on investment. Then the second factor you are talking is you're talking of liquidity, right? Uh, some of you are talking of earnings per share. Okay. Some of you are talking of some debt equity ratio. Okay. Then okay, there's something called as reputation of the company. Okay, reputation of the company. Profits. Okay. Right. So these are basically few of the factors which you have listed out over here. Now, my question to you is, these are some of the factors which are stated, sir, which you will consider, uh, while deciding. I can actually club them together into broadly four areas. Into four areas. Now, which are those four areas? First up, we're talking of the profitability. First up, we're talking about the profitability. Secondly, you have also said about liquidity. The liquidity as a second criteria. Third, we talk of activity. How active the company is. And then finally, you're talking of return on investments. Okay. Some of these parameters that you have stated, I can group it into these four major areas. Now, my question to you is, how are we going to measure these numbers? How are we going to measure these numbers? How to measure these numbers, guys? How to measure? Of course, the but natural answer for this is, we are going to measure this by some sort of numbers or percentages or ratios, right? Right. So we're going to measure them by numbers, percentages, and ratios. So, guys, the whole idea over here is to compute some numbers, compute some percentages and ratios to know about the various types of these parameters. Now, when it comes to types of ratios, let me just spell it out to you. What are the various types of ratios that we have? Types of ratios. In all, we are going to have four types of ratios. Overall, we are going to have four types of ratios. One is the set of liquidity ratios. Second is the set of leverage ratios. Third is the activity ratios. And last is the profitability ratios. Remember, liquidity ratios are going to be helpful in understanding the short-term solvency. Liquidity ratio is going to be helpful for us in understanding the short-term solvency of the company. Leverage ratios are going to be helpful in understanding the long-term solvency of the company. Activity ratios are going to be useful in understanding the efficiency of the company. Okay. And profitability is going to be in terms of return on investment sort of thing. Okay. Right. So these are the the various types of ratios that we are considering in this typical chapter. These are the broad categories. A lot of different ratios are we are going to definitely discuss. Okay. So these notes will be available once our class is over today. I will upload this on the portal, so you need not worry about that. I've already uploaded the previous class notes on the portal. You can access it. Even these notes will be uploaded in the due course. Okay, so these are the types of ratios that we are going to look at. Now, let me just begin with a concept and then we'll take it forward accordingly. Now, let us say we have a company, let's say R Limited, for which we have the information as to what is the amount of current assets. So let's say R Limited is having a current assets of 10 lakh. R Limited is having a current assets of 10 lakh. And there is another company, let's say Q Limited, which is having a current asset of 1 crore. Kiran, Yasir, you will get these notes. I have uploaded them. You will get it in the due course. The notes for the previous class has already been uploaded, so you can access it. This class notes I will be uploading once we are done with today's session. So I'll be uploading all of this on the portal. You need not worry about that. Okay. So now tell me, there are two companies, R Limited and Q Limited. Now tell me, out of these two companies, R and Q, which one is more solvent? Which one is having more liquidity? Can you tell me? Out of this R and Q, which company has got a greater degree of liquidity? Which company has got a greater degree of liquidity? Yeah. Is it R or is it Q? What is your opinion? Which company has got a greater degree of liquidity? Q Limited. Well, most of you have got it wrong, guys, because you just can't be looking at current assets and decide, which is more liquid. Rather, along with current assets, you should be considering the current liabilities. You should be considering the current liabilities. Right? So let us say now I tell you that R Limited is having a current liability of 5 lakh and Q Limited is having a current liability of 95 lakh. So now you tell me, guys, over here, the net current asset or net working capital is 5 lakh. Now, out of these two, tell me which one is having a greater degree of liquidity? Which company is having a greater degree of liquidity? R Limited or Q Limited? Which one is having greater degree of liquidity? Can I compare, look at only net current assets? No. If that is the case, let me tell you another company case, which is, let's say, S Limited. it is having a current asset of, let's say, 10 crores and current liability of 9 crore 95 lakh. Even this has got a net current asset of 5 lakh, but that doesn't make uh, all three companies to be of same liquidity, right? So I cannot be saying that this company is having a better liquidity just because it has got more current assets or just because it has got more net current assets. No. So if you want to really decide which of these companies are good in terms of liquidity, we are going to have a relative figure of current asset and current liability. We are going to have a relative figure of current assets and current liability. And for that, we compute something called as current ratio. Compute a number called as current ratio. Now, how do we compute this current ratio? The formula for calculation of current ratio. Current ratio, current ratio. It is computed as current ratio is simply the current assets divided by current liabilities. Current assets divided by current liabilities, right? So over here, if I compute the current asset for each of our companies, we can say R Limited, this company R Limited has got a current ratio of 10 lakh by 5 lakh, which is 2 is to 1. Q Limited has got 1 crore is to 95 lakh. So here this ratio typically comes out to be 1.05 is to 1. And this one for company S, the ratio is even more smaller, which is 1.005 is to 1. Now, how do we go about interpreting this current ratio? What is the interpretation that we can place for this current ratio? Listen, if current ratio is equal to 2 is to 1, what does that imply? If current ratio is equal to 2 is to 1, what does that imply? It means for every P1 of current liability, for every rupee 1 of current liability, company has rupees 2 as current asset. Rupees 2 as current asset. So for every 1 rupee of liability, you have 2 rupee of your assets. For every 1 rupee of liability, the company has 2 rupee of assets. So tell me, when do you say that a company is having a more liquid position? When the current ratio is higher or when the current ratio is lower? So if the current ratio is higher, it means the company has a more level of current asset as compared to current liability, and that makes us, a safe situation for the company, right? So here we can say higher current ratio means greater liquidity. Higher current ratio means greater liquidity. So if the current ratio is higher, it means greater liquidity. But there is an exception. Just look at it. Suppose if our current ratio is 2 is to 1, or 3 is to 1, or 10 is to 1, or maybe 20 is to 1. The company which has got this high current ratio of 10 is to 1 or 20 is to 1, what does that signify? It means company is having a very great level of current assets a very great level of current assets as compared to current liabilities, right? So the company has got 20 rupee of current asset for 1 rupee of current liability. So they have got very great amount of current assets. Now tell me, a larger number of current asset, a larger quantum of current asset, what does that signify? What does that signify? High current ratio implies high level of current asset, right? High current ratio indicates high level of current asset. Now, when you say high level of current asset, it actually indicates inefficiency. It actually indicates inefficiency. So let's say if we talk that there is a high current asset level, it means the company has got high level of stock, or maybe the company has got high level of debtors, or maybe the company has got high level of cash and bank balance, right? So if you're having great amount of stock in your balance sheet, if you're holding very good amount of stock in your balance sheet, what does that mean? If it is high stock, what does it mean? It means you are actually having a selling inefficiency because you're not able to sell your goods. So you have selling inefficiency. If there is high level of debtors, it indicates, high level of debtors, it indicates collection inefficiency. It indicates collection inefficiency. If you're having great amount of cash, the company is having huge cash balance, but what's the use of it, right? If the company is not able to invest it, it doesn't make sense to keep that much amount of cash. So if you're having high level of cash in bank, it indicates investing inefficiency. It indicates investing inefficiency, right? So high current asset means you have high stock or high debtors or high cash in bank. And then, of course, these three are the higher degree of inefficiencies that we are talking about. Okay. So, sir, having high current ratio means greater liquidity, but very high current ratio indicates inefficiency. Very high current ratio indicates inefficiency. So, I need to specify what do you mean by the ideal current ratio? What do you think? What will be the ideal current ratio? Ideal current ratio is 2:1. Ideal current ratio is 2:1, which means you are having a sufficient liquidity in your books, which means you're having a sufficient level of liquidity in your books, which is like, there is an ideal current ratio of 2:1. Okay. So that's the simple discussion about the current ratio. Now, let us consider the balance sheet of a company, current assets. So let's consider current asset and current liability. Current asset and current liability of a company. Okay. So let's say it has got this balance sheet. On the asset side, you have got a cash balance, you've got a bank balance, you've got some short-term investments. Okay. And then you have got some debtors. You're having some stock. And you have some sort of prepaid expenses. Let's say you have got some prepaid expenses also. So quantifying them, suppose you have got a cash balance of 1 lakh, okay, a bank balance of maybe 5 lakh, short-term investments, let us say amounting to 4 lakh, and let's say we have got some debtors amounting to 3 lakhs. Stock is to the tune of 10 lakh, and prepaid expenses is let's say 7 lakh. So total current asset works out to be what? 10, 7, 17 plus 3, 20, and the balance it comes out to be 30 lakh, right? And on the liability end, you have the creditor. On the liability end, you have creditors, which is 15 lakh. 15 lakh. Okay. So now are we having this ratio as 2:1? Yes, because over here the current ratio is definitely fitting out to be 2:1. So now suppose the debtors ask for money. Let's say the creditors are asking for their money. Creditors are asking for repayment of the amount due to them. So how are we going to make payment to the creditors? Tell me. How are we going to make payment to the creditors? Payment to creditors. Which current asset am I going to utilize to satisfy the claims of creditor amounting to 15 lakh? Of course, the first thing that we are going to utilize is simply first thing that we are going to utilize is this cash balance of 10 lakh, sorry, 1 lakh. Then we will also utilize the bank balance of 5 lakh. You may even sell the short-term investments, which is to the amount of 4 lakh, right? And you may be also able to get the money collected from debtors by way of you know bill discounting, right? So let us consider you're able to get the bill and get it discounted from the bank and try to pay to the creditors. So now to make payment to the creditors, these are going to be the negative figures. And after considering all of them, are we able to satisfy all the claims of our creditors? Have we paid everything to the creditors? Is the entire 15 lakh paid to the creditors? Has the entire 15 lakhs been paid to the creditors? No, right? There is still an outstanding amount. What's the outstanding amount? See, out of 15 lakh, what we have been able to pay is 1 plus 5, 6 plus 4, 10 and 13. So we still have a balance of 2 lakh pending to be paid, right? So balance still to be paid to creditors. Balance still to be paid to creditors is 2 lakh, right? So now the question comes, sir, we have tried to maintain a current ratio of 2:1, but still we are not able to pay the creditors, because if someone says, if some duffer says that, sir, let us give stock to the creditors. How can you give this stock to your creditors? Because you have got the goods from him itself, right? So he would say that, why the hell are you buying from me then? If you just want to return the stock, because 15 lakh is outstanding amount and you give the 10 lakh as stock as return. So, you cannot do that. In fact, even if you sell the stock, you may not be able to realize it immediately, right? So the idea is, in spite of having this 2:1 ratio, still you will face a liquidity crunch. Of course, you can get a loan from bank and pay it off, and those all things are there. But I'm talking of the relation between current asset and current liabilities. Are these assets sufficient enough or capable enough to pay my creditors? No. Why? Because in this asset, we have got two items. We've got two items in this series of assets, which are not good enough to pay to the creditor, right? So if these two are definitely current assets, but I cannot use them to pay to the creditors. And that is the shortcoming of this current ratio. And for that reason, we have got a improvised version in which we compute something called as quick ratio. We compute quick ratio, which is also said to be the acid test ratio. It's a quick ratio, acid test ratio. This is also called as the liquid ratio. Now, this liquid ratio or quick ratio is going to be considering only quick assets, and in the denominator, we are going to have the current liabilities. So what do we have in this quick assets? What are the items of our quick assets? See, from this entire set of current assets, we had these two current assets which were actually not useful for paying the creditors. So we essentially remove them from our books. So essentially what we do is current asset minus inventory minus prepaid expenses. The current asset minus inventory minus prepaid expense, and then the whole thing divided by the current liability. Current asset minus inventory minus prepaid expense, the whole thing divided by the current liability. That's the quick ratio. Okay. So if we talk of, sir, what all is included in the quick ratio, you can say, sir, cash is included, bank is included, short-term investment is included, and even debtors are included, considering that you can get the bill from the debtors and get it discounted from the bank. Right. So these are your the ideal quick ratio. Ideal quick ratio is 1:1. Ideal quick ratio is 1:1. Right. Then even more strict version of this is, there's another ratio which says if you try to get money from the debtors, they will not pay you the money. In fact, what the debtors will give is they'll give you a bill receivable. And with that bill receivable, you can get it discounted. But when you're going to get it discounted with the bank is going to charge you some commission and you will lose value. Right? You will lose value. So, and therefore, we look at the next ratio, which is even more strict, which is cash ratio. Cash ratio or absolute liquid ratio. Cash ratio or absolute liquid ratio, which is going to be cash plus bank plus short-term investment, the whole thing divided by current liability. Right? So cash plus bank plus short-term investment, that's going to be divided by current liability, which is going to be an absolute liquid ratio. And this absolute liquid ratio is the most strict form. And remember, if this ratio is 1:1, ideal quick ratio. If this ratio is not quick ratio, it is actually ideal cash ratio. Our ideal cash ratio is 1:1. Then we say that it is the best possible scenario. You are not at all likely to default on payment to your creditors because you have exact amount of liquid asset in the form of cash, bank, and short-term investment, which will you can using which you can pay off your current liabilities. Okay, so that's your three short-term liquidity ratio that we are talking of, which is the current ratio, quick ratio, and cash ratio. Okay. Uh, But these three ratios are actually comparing whether you have assets to pay off your liabilities. Correct. So if you look at the current ratio, that's the ratio between current asset and current liability, whether you have assets to pay off your liabilities. Even in the quick ratio, it says whether you have quick assets to pay off the liabilities. Even in case of cash ratio, it says whether you have absolute cash balances to pay off your liabilities. But in essence, when we want to see whether the company is having enough degree of liquidity or not, you should actually be looking at, does the company have, you should actually be looking at, does the company have sufficient quick assets to meet the day-to-day expenses, to meet the day-to-day expenses. Now, how do I know that I have sufficient amount of quick assets or cash and bank balance to pay day-to-day expenses? So for that, we use a measure called as basic defense interval. So we use a measure called as basic defense interval ratio or interval. Okay, basic defense interval. This is going to be calculated by dividing something by something, and answer is going to be in so many days. Okay, so basic defense interval ratio is going to be a numerator upon denominator, which will be obviously having some number of, it will be measured in number of days. Now let us understand this the very simple example. Let's say your daily expense, your daily expense of traveling, or daily expense of outside food and everything. Let us consider that you have a daily expense of rupees 100, and in your wallet you have a cash balance. In your wallet you have a cash balance of, let's say, 2000 rupees. 2000 rupees. Can you tell me what is the number of days? What is the number of days for which sufficient cash is available? Can you tell me what is the number of days for which sufficient cash is available? Let's say your daily expenditure is 100 and in your wallet you find that you are having 2000 balance. So what is the number of days for which sufficient cash is available? Or I can say, without withdrawing or without asking for any more pocket money, how many days can you survive? Can I say your answer will be 2000 divided by 100, which is 20 days, right? So on the similar lines, we have this basic defense interval ratio even for the companies. Even for the companies, we have this basic defense interval. So basically, we are looking at company is having cash balance equal to how many days? The company is having cash balance equal to how many days? Okay. So basically, company will not be having much into the cash and bank balance itself. The company keeps assets in multiple ways, right? So company has got the quick assets. How much quick asset the company has got divided by your operating expense per day. The quick assets divided by operating expense per day. The basic difference interval ratio, it works out to be quick assets upon operating expense per day, right? So now tell me what are we really going to have in this operating expense per day? What are we really going to have in this operating expense per day? So when you're looking at operating expense per day, that is simply going to be your COGS, which is cost of goods sold, plus whatever expense you're incurring for selling purpose, like advertisement, sales, promotion, and all. Right now, COGS plus selling expense, then plus general admin expense. Right. So these are your operating expenses, right? So for running your business, you need to incur these expenditure. You need to incur your COGS expense. You need to incur selling and admin expense, right? Now, of course, these selling admin general COGS may have some component of depreciation and amortization. So we remove those non-cash component from this. COGS might be having some amount of depreciation, some amount of amortization. Even selling and general admin may have, like, selling expense may have the depreciation on the delivery van. General admin expense may have the depreciation on the computers. But these admin selling expense, which are in the form of depreciation and amortization, they are essentially not cash expenditure. Those are the expenses which are, non-cash. So you're not paying it in cash. So essentially what we do is we subtract the depreciation and amortization. We subtract the depreciation and amortization. And of course, when you say per day, that is simply going to be this entire thing divided by 365. Right? So that's how you compute whether you're having sufficient cash or sufficient quick assets to sufficient quick assets to get the amount of money, or do you have sufficient quick assets to pay your operating expense on a day-to-day basis, right? So this is your basic defense interval ratio. Okay, this is what we are talking of as a basic defense interval ratio. Okay, now I hope we are good till now. We have done how many ratios till now, guys? We have done 4 ratios. First one was current ratio, second was liquid ratio, third was absolute liquid ratio, and this fourth is basic defense interval ratio. Perfect. Now these 4 ratios are into the category of short-term solvency or liquidity ratio. These are into the short-term solvency or liquidity ratio. So that's the first part which we have done. Okay, let me look at the queries if there are any. While computing quick assets, if there are also income receivable, then it should be added. Quick assets, yes, you should include. In case of quick assets, you should include the receivable, not the income receivable. But the income receivable won't be added. The trade receivables will be added. Income receivable is something that you're going to receive in future, which you cannot use to pay off your creditors, right? Then what should a company follow? Because a company maintains idle cash ratio, so the current ratio will be not as ideal. Company should maintain a current ratio of 2:1 and cash ratio of 1:1. So that will be a sufficient number to satisfy the claims of the creditors. Okay. Malvika Pillai is asking, sir, how is credit and investment advisory services a source for financial analysis? Credit and investment advisory services. This is credit and investment advisory services. It's a source of financial analysis. Uh, those services which you're talking, those are a part of financial analysis. That is one of the type of financial analysis that is done at Econ. What's the current ratio? What's the shortcoming of current ratio? Darshan, I just explained shortcoming of current ratio is like you are considering the total current assets, because inside the total current asset, there are some current assets which you cannot use to satisfy the claims of the creditors. Okay, fine. Now let's look at some of the other ratios which are now going for the uh, leverage ratio or long-term solvency ratios. So we are looking at long-term solvency ratio. Okay. Now let us say we have three companies, P, Q, and R, and there you have something called as owned funds. Owned funds are basically comprising of equity share capital plus reserves, right? That's your owned funds. Or I can say this is your equity funds. Then you have preference share capital and you have debt. So we know that equity funds and preference share capital combined, we call them as owned funds. P, Q, and R, we have this preference share capital and equity funds. To combine them, we have the owned funds. So equity funds are, let's say, a company has got its first company, P is having a equity fund of 10 lakh. Q is having a equity fund of, let's say, 8 lakh, and preference share capital of suppose 2 lakh. No, sorry. Let's say equity fund of 5 lakh, and R is having an equity fund of, let's say, 2 lakh. As of now, for the time being, let me just not consider uh, the preference share capital. We'll bring that preference share capital at a later point of time. So our owned fund still is what we have as the 10 lakh figure. And if we have borrowed funds, P is having a nil borrowed fund, Q is having a borrowed fund amounting to 5 lakh, R is having a borrowed fund of 8 lakh. So total funds or total capital employed in the business, total uh, capital employed in the business is like 10 lakh in all the three companies. But just looking at these numbers, total investment that you have in the company is same. It is same 10 lakh. However, there is a structural difference between the owned funds and the borrowed funds. There's a structural difference between the owned funds and borrowed funds. So looking at these three companies, can you tell me which company is supposed to be liquid in a long term? Which company is supposed to be in a liquid state in a long term? Yeah, tell me. Which company is more liquid in a long term? It's just about the considering the ratio between owned funds and borrowed funds. Which is a company which has got a greater degree of long-term solvency? Long-term solvency, which company has? Which company has got a long-term solvency? P, Q, or R? Okay. Uh, Ideally, it should be P, right? Because the company is fully funded by equity. The company, this company P is fully funded by equity. So 10 lakh is the amount of equity fund which is fully funded. P is the 10 lakh which is fully funded by the equity. So this is having the least level of risk, because understand that whenever you have a loan on the balance sheet, it's a risk for the equity shareholders that if tomorrow company doesn't pay, the bank will come and ask for the money or ask for the realization from by selling the assets. So that's your problem with loan. So whenever you talk of loan, it's always a risky scenario. It's always going to be a risky scenario. So P is said to be the most solvent one. Now to measure this solvency ratio, we have few ratios to measure. So let's just put it up over here. Let's say I'm just going to break this further. Let's say preference share capital is nil over here. 4 lakh is the equity fund and 1 lakh is the preference share capital, and R is having a 1,50,000 of equity and 50,000 of preference share capital. So the total owned funds is 10 lakh, 5 lakh, and 2 lakh. Okay. Now, how to measure the risk that we said, that is a long-term solvency part. So for that, we have certain ratios. So let's have a quick look at those ratios. The first ratio that we have is called as the debt equity ratio. Now, as the name says, debt equity ratio, debt equity means we have the debt upon owned funds. Now, remember over here, don't go by the word equity. Here, equity means owned funds. Okay. So, over here, debt equity ratio, it means debt upon owned funds. So, basically, what is included in debt? It includes both short term as well as long term debt divided by equity share capital plus preference share capital plus reserves minus any sort of fictitious assets. So equity share capital plus preference share capital plus reserves minus any fictitious assets. Okay, so that's your debt equity ratio, which is comparing for this interpretation for this goes as for 1 rupee loan, how much owned funds a company has. So for every 1 rupee of loan, how much owned funds does the company have? Now over here, understand fictitious assets is the debit balance of P&L which has not been subtracted, which is shown as a asset in the balance sheet, or any sort of miscellaneous expenses which have not been written off, right? So all those things are your fictitious assets which you cannot sell it to anyone. Those are appearing on the balance sheet asset side, but they are not essentially assets. Okay. So for 1 rupee loan, how much owned funds a company has? This is what the debt equity ratio tells us. So we have the next ratio, which is the debt ratio. Debt ratio is simply comparing the total debt total debt, which is short-term as well as long-term debt, divided by the net assets. The debt ratio is short-term and long-term debt divided by the net assets. So we have this number, total debt, which will include short-term as well as long-term. Now this number is actually telling you for rupee 1 of assets in company, how much is for rupee 1 of assets in the company, how much is the debt amount? For every 1 rupee of asset, how much is the debt amount? Or you can say that is what proportion of assets are funded by what proportion of assets are funded by borrowed funds. What proportion of assets are funded by the borrowed funds? So that's your debt ratio. Okay. Then a replica or a mirror image of debt ratio is what we call it as equity ratio. Equity ratio. So equity ratio is, so by the way, this net asset means fixed asset plus current asset minus current liabilities. Okay. So the equity ratio simply means shareholders' funds upon net assets. Now remember this shareholders funds. How do we compute these shareholders funds? What is the owned funds, whatever you have, right? So for shareholders funds, you have like equity share capital plus preference share capital plus reserves minus any fictitious assets. This whole thing divided by net assets. And the interpretation of equity ratio is also on this similar line, where wherein we are going to say for 1 rupee of asset in liability, how much is the owned funds? That is, what proportion of assets are funded by owners, right? So this is what we mean by the debt equity ratio, debt ratio, and equity ratio. Okay. So now looking at these numbers in this example, PQ and R, I want you guys to compute these three numbers for PQ and R. Tell me, guys. For the three companies PQ and R, I want you to compute the debt equity ratio, the debt ratio, and the equity ratio. Yeah, guys. I'll just give you 2 minutes for this. Compute all the three ratios for the companies that I have mentioned over here. Compute the three ratios, guys, for PQ and R. Try to get the numbers. I'll wait for a minute for that case. First compute the debt equity ratio for all three, and then the debt ratio, and then the equity ratio. It's quite obvious that net assets figure is going to be the total capital employed itself, because here we take fixed asset plus current asset minus the current liability, right? So when you take this as a figure, that's ultimately going to be equal to the total capital employed simply by the balance sheet asset liability equation. So get these three numbers, get the three ratios for company P, Q, and R. Yeah. What are the numbers? I think it should be for debt equity ratio. In first case, it should be 0 for P. For the Q, the debt equity should be 1:1. And for R, it should be 4:1. Debt ratio is, first case, it is 0. For Q, for in case of debt ratio, that should be 0.5. And for R, it should be 0.2. Equity ratio, we have the P value as, it should be 1. For Q, it will be 0.5. And for R, it will be 0.8. Are these numbers, guys? Just check. Are you getting these numbers? The debt equity and the debt ratio and the equity ratio for the three companies P, Q, and R. Are we getting these numbers? Yeah. Please confirm you are getting these numbers, because if you're getting these numbers, it means you are getting how to calculate the ratios for this for the case of these three ratios as of now. Got it? Okay, so Malvika has got it, Sudhanshu has got it, Krishna has got it. Okay, great. You're able to get it? Perfect. Shubham, there is no fixed asset as such which we need to calculate over here, because we need the net assets, and net assets will be equal to your total capital employed. Yeah, fine. Now, we're going to look at the next ratio called as capital gearing. Okay, something called as capital gearing. But before that, we need to understand what is capital gearing. Okay, so let me just take the case of the same companies. The same set of companies, P, Q, and R. So we are looking at what is capital gearing, and then we'll understand what is a capital gearing ratio. So my question to you is over here, what is capital gearing? So we have equity funds, preference share capital, and borrowed funds. Now let us say all the three companies are into the same line of business. All three companies are into the same line of business. It means they are, as far as operations are concerned, they are working on similar lines. It means they have the same level of sales, the same amount of operating cost, the same amount of purchase cost or salaries that are paid. So everything is same. So they have sales less. You have the COGS that will give you the GP. From this, you subtract your admin cost. You subtract the selling and distribution cost. Now, the profit that you will get after subtracting all this from from the sales, it's going to be the same for all the three companies, because I'm saying that all three companies are into the same line of business. So let's say I tell you that they generate a profit called as earnings before interest and tax. So this is the amount of profit which the company is making before payment of any interest. So let us say EBIT that is being generated is 3 lakh for all three companies. So we have a EBIT of 3 lakh for all the three companies. So all three companies are having the same amount of EBIT because they are into the same line of business. Okay. Now from this EBIT, we will subtract the interest, right? Then we will get the profit before tax. From this, we are going to subtract the taxes. Let's say taxes at the rate of 30%. So you get profit after tax. And from the PAT, you will subtract preference dividend. Let's say this preference share capital is requiring preference share capital is requiring dividend payment at the rate of suppose 12%, and the amount of borrowings that you have, there you have the rate of 10%. That is, interest need to be paid at the rate of 10%. So we have this sales, uses, and everything is same for all the three companies. So that is what we mean as that is same for all the three companies, right? So sales, COGS, GP, admin, selling, and distribution, everything is same. Just we start with the EBIT. So after EBIT, the things are going to change because after EBIT, interest needs to be computed. Interest will be computed on the basis of the loan that you have. PBT, tax, you have to subtract, you will get the preference dividend. And after that, you will get the net profit for equity shareholders. You'll get a net profit for equity shareholders. So we first subtract the interest, then the taxes, then the preference dividend, and then the net profit for equity shareholders. Okay, so we're getting the net profit for equity shareholders. Okay, now over here, I want you guys to compute or fill up this entire income statement. Looking at these numbers, you have the total capital employed given, you have the preference share capital given, you have the borrowed funds given. I want you guys to compute the interest, the PBT, the taxes, the PAT, the preference dividend, net profit for equity shareholders. You have to complete this entire table. Okay, so what we'll do is we'll take a short break right now, and that break will be for around 10 to 15 minutes approx. And in that break, just take a break of 5 minutes, and in the balance time, what you're supposed to do is you need to fill up this entire table. So try to fill up this entire table Try to fill up this entire table. And we will discuss the numbers after the break. And Okay, welcome back after the break, guys. I hope you have computed these numbers. Let me just put the numbers for you so that we can refer and understand and analyze them in the next stage. So, coming to interest, for P, there's no preference share capital and not even borrowed funds. So, over here, you can say interest is nil. Profit before tax is 3 lakh. Tax at the rate of 30% means 90,000. Profit after tax is 2 lakh, 10,000. No preference dividend. So, entire 2 lakh 10,000 is the net profit for equity shareholder. Then, for the second one, uh, we do have preferential capital and borrowed funds over here. So interest that will be subtracted will be 10% of 5 lakh, which is 50,000. Profit before tax is 2 lakh, 50,000. Taxes at the rate of 30%. So 2 lakh 50 with 30%, so that's 75,000. Profit after tax is 1 lakh 75,000. Preference dividend, uh, there's a preference share capital of 1 lakh on which you need to pay 12%. So 1 lakh into 12%, which is 12,000. So you have a net profit for equity shareholders as 1 lakh 63,000. Okay. Then for the last company, interest is going to be 8 lakh multiplied by 10%, which is 80,000. Profit before tax is 2 lakh 20,000. So taxes at the rate of 30%, that will be 66,000. So you have a PAT of 1 lakh 54,000. And then you have a preference share capital of 50,000. So on that 12%, which amounts to 6,000. So 6,000 of preference dividend, you have 1 lakh 48,000. Okay, so 2 lakh 10, 1 lakh 63, 1 lakh 48,000. So these are the three numbers that we have net profit for equity shareholders. Now my question to you is, out of these three companies, which has really performed well in terms of profitability? Which company has performed well? Is it P, Q, or R? In terms of profits for the equity shareholders, which company has performed well? I'm talking of profits for the equity shareholder. Which company has performed well? Okay, so everyone is saying it is 2 lakh 10,000 for P. So net profit for equity shareholders, 2 lakh 10,000 is highest for P, and therefore you say that P is the maximum profit making. P is the highest profit making. So 2 lakh 10,000, that's the net profit for equity shareholder. Right? But then you're not looking at the other aspect. Here, we calculate an important ratio, which is return on equity. So for the equity shareholders, on their investment, what is the rate of return which they have generated? What is the rate of return that they have earned? So let's look at this return on equity. Return on equity is like the shareholders are earning 2 lakh 10,000. Shareholders are earning 2 lakh 10,000 on an investment of, what's the investment of equity shareholders? See, 10 lakh. So return on equity is basically computed as net profit for equity shareholders upon equity shareholders funds, which is basically 2,10,000 divided by 10 lakh. That works out to be 21%, right? What about the second company? So for second company, you have this as 1,63,000 on equity shareholders fund of 4 lakh. So on this 4 lakh, the equity shareholders are earning 1,63,000. So what's the rate of return in percentage terms? So in percentage terms, that's 163 divided by 400, which is 40.75%. What about the third case? So in the third case, you're earning 1,48,000 upon an investment of, what's the investment of equity shareholders? 1,50,000. So on an investment of 1,50,000, the shareholders are getting 1,48,000. That amounts to total of 98.67%. That gets converted to 98.67% return. So the notion that we had that company P is performing good, that is not actually true. What you observe is this 21% is a good number, but then if you look at the return on investment for the next company, for the last company, that works out to be 98.67. So R is having a better return on investment or return on equity. Okay. So that's what we call it as capital gearing. That's what we call it as capital gearing. See, when you are looking for driving any vehicle, when you're looking for any vehicle, be it a four-wheeler or a two-wheeler, which has got a gear, right, which has got a gear, you know that if you want to go at a higher speed, if you want to travel at a speed of around 100 or 120 kilometer per hour, can you be driving the vehicle in the first gear? That's not possible at all, right? So to take the vehicle at a higher gear, or I can say at a higher speed, you need to increase the gearing, right? You need to increase the level of gear from first to second to third to fourth to and even maybe up to fifth. So here in this case for the three companies, if you look at the balance sheet, if you look at this, their sources of funds, the total capital employed is same. Just as in the vehicle, the engine runs at the same capacity. However, what is the determining factor for your speed? It is the gear which is determining factor, right? So total capital employed is same for all the three companies. However, in company Q, you have a preference share capital and borrowed funds. You have preference share capital and you have borrowed funds. And even R has got preference share capital and borrowed funds to a larger extent. So company R is having a higher degree of gearing because it has got the funds, the outsiders funds to a larger extent as compared to the insider. R has got a outsiders funds to the larger extent as compared to the insiders. So here we say that R is highly geared. P is having no gearing at all because it is not having any preference share capital or borrowed funds. Now, how is that gearing helping us? Now look at this case. Without any gearing, the company is able to generate 21% return on equity. Without any gearing, the company is able to generate 21% as the return on equity. And when it goes for a higher level of gearing, it's able to generate 98.67%. It is able to generate 98.67%. Right? So under that scenario, 21% or 40.7 or 98.67, you're going for a higher level of gearing. So when you're having higher level of gearing, you're able to generate a higher return. Without gearing, you are having 21%. So it means your business is actually giving you 21% return. the funds that you put in your business are generating you 21% return. But what is the cost of the preference share capital and borrowed funds? You observe that preference share capital are, they are being obtained at 12%. Borrowed funds are being obtained at 10%, which is lower than 21%, right? So essentially, what you say is, sir, this is your business. You put in funds, the borrowed funds and the preference share capital, right? And the business is giving out 21% return, whereas the borrowed funds or against the business is actually earning. Oh, 1 second. The business is earning 21%, but on which it is supposed to be, or against it is earning 21% on 10 lakhs. It is earning 21% on the 10 lakhs. On the other hand, the preference share capital and the borrowed funds, the preference share capital and the borrowed funds require, preference share capital require 12% and borrowed funds require 10%. So preference share capital require 12%, borrowed funds require 10%. So it means this 12 and 10, you are actually getting funds at a lower rate. You're able to get the funds at a lower rate and you're able to generate returns at a higher rate. And that's what we mean by gearing. You are raising funds at a lower cost and investing in areas which is giving you a higher rate of return. Okay, so that's what your business is. And therefore, the shareholders are actually able to generate 98.67. Right? So if you look at this business, which has got preference share capital and borrowed funds, what is being obtained by the equity share capital is 98.67%. Or to put it in a very more, in a much more simpler way, I can see the business is giving out, 10% on borrowed funds. The business is giving out 12% on preference share capital. So let me just consider, borrowed funds of rupees 8 lakh, preference share capital of rupees 50,000, and equity share capital is getting actually 98.6% on equity shareholders fund of rupees 1.5 lakhs. So business is generating 21% on 10 lakhs, and that 10 lakh on 21% on 10 lakh, that is distributed in three patterns. 8 lakh on the borrowed fund of 8 lakh, you pay them 10%. On preference share capital, you pay 12%, and whatever is left out, that goes to the equity shareholders. That goes to the equity shareholders, and that is what we mean by the capital gearing. So capital gearing is happening because of borrowed funds and preference share capital. It's not happening because of equity shareholders. Rather, when you don't have preference share capital or borrowed funds, your whatever you're earning 21%, that same is paid out to the equity shareholders also. Right? So here we are talking of this capital gearing, in which you are having the capital gearing because of two aspects. One is the preference share capital and other is the borrowed funds. And that brings us to the next ratio, which is capital gearing ratio. Capital gearing ratio, which is borrowed funds plus preference share capital. It means these are the two sources of funds on which you need to pay a fixed rate of return. These are the two sources of funds on which you need to pay a fixed rate of return divided by borrowed funds plus preference share capital divided by equity shareholders funds. So borrowed funds plus preference share capital divided by equity shareholders fund. That is what your capital gearing ratio is. And remember, all the ratios that we have done, they indicate certain things. Whether they indicate the solvency and risk. For example, debt ratio. If debt ratio is high, it indicates there is less solvency and more risk. If debt equity ratio is high, it indicates less solvency and more risk. If your equity ratio is high, it again indicates more solvency but lesser risk. Then similarly, capital gearing ratio, if your capital gearing ratio is high, you are moving at a greater pace. It means you've taken a lot of debt and preference share capital. So you're actually having a greater degree of risk and the solvency is lower. Okay. So that's the three, or again, say four set of ratios, four ratios which we have for long-term solvency. Is this clear, guys? All the four ratios are clear? Everyone? Are all the four ratios clear? Are all the four ratios clear? All the four ratios clear, guys? Risk is for the business as well as for the lender, Darshan. Risk is for the business as well as for the lenders. So as we follow the simple rule, when you are going for a higher capital gearing ratio, you actually have a greater degree of risk. So if you're taking greater degree of risk, you can expect a higher return in that case also. Okay. Borrowed funds will include long term as well as short term, both. Shubham is asking, but sir, ultimately money goes to the equity shareholder. That is more in company P. Uh, Money goes to the equity shareholder, but what if I say you per equity share? Like the total equity shareholder fund is 10 lakh. So 1 rupee per share. So if I say there are 10 lakh equity shareholders, and for each equity shareholder, you have just 0.21. And whereas for each equity shareholder, you have 98.67%. So per equity share, it is going to be higher in this case. Because if your amount is 10 lakh, even the number of equity shareholders are going to be large. Correct? I hope it is clear to you. Yeah. Okay. Now, talking about the long-term solvency, we need to look at some more ratios, some more numbers, which is, you know, long-term solvency should also consider long-term solvency, should also consider the ability to pay the dues on time. Whether the company is really capable to pay the dues on time. So how do we measure that ability to pay? So let's say there are three persons, Mr. X, Mr. Y, and Mr. Z. Now they've got a salary. Let's say Mr. X has got a salary of 1 lakh. Mr. Y is having a salary of 50,000. And Mr. Z is having a salary of 20,000. If I ask you that we are talking of an EMI, let's say Mr. X is having a current EMI of 40,000 to be paid. Mr. Y is having a EMI of 30,000 to be paid. and Mr. Z is having a EMI of for 25,000 or 25, but let's say 35,000 to be paid. Can you tell me, out of these three persons, who is more capable or who is having a greater ability to pay? Who is having a greater ability to pay? Amongst the three persons, Mr. X, Y, and Z, who is having a greater ability to pay? Who is having a greater ability to pay? Is it Mr. X who has got the more ability to pay, or Mr. Y, or Mr. Z? It would be dumb on us if I just compare the EMI amount, right? Rather, what I should ask you is, can you tell me how many times is the income, how many times of EMI is the income? How many times of EMI is the income? Tell me. So this can be simply computed as 1 lakh divided by 40,000, which is what, 2.5 times. So Mr. X has got an income which is 2.5 times of his fixed obligation. Over here it is 50,000 divided by 30,000. So here the number of times EMI of income, that works out to be what, 1.67 times. And in case of Mr. Z, you have this as 60,000 is the income, and you need to pay a fixed obligation of 35,000. 60,000 divided by 35,000, which is 1.714 times. 1.714 times. Yeah, 1.714 times. 2.5, 1.67, 1.714 times. So which person is having a more ability to pay? Which person is having a more ability to pay the dues? Of course, it is this Mr. X. So to measure this ability, we have got certain ratios to measure how a company, or to measure whether a company is capable of to pay the dues. So for that we have certain ratios, and those ratios are, the first one is interest coverage ratio. Okay, and then we have the preference dividend coverage ratio. Interest coverage ratio is basically EBIT upon interest. Preference dividend coverage ratio is profit after tax upon preference dividend. So this interest coverage ratio means how many times of interest is EBIT. Now remember that as you look at these ratios, if these ratios are large, if these interest coverage ratios are large, or preference dividend coverage ratio is large, then you say that you are in a more safe situation, or you are having more capability to pay, having a more capability to pay the interest or to pay the preference dividend. Okay. Next ratio on this coverage ratio funda itself. We have this coverage ratios. So we have seen two coverage ratio. One is the interest coverage ratio, other is the preference dividend coverage ratio. The third coverage ratio is fixed charges coverage ratio. Now, this fixed charges coverage ratio considers basically the EBIT, which is earnings before interest and tax, plus you add back depreciation. Now, why are we adding back depreciation? Because when we have computed EBIT, you might have deducted the depreciation, which is a non-cash expenditure. So that non-cash expenditure is added back to the EBIT. So that becomes EBIT plus depreciation divided by interest plus principal repayment. Right. So you have in the numerator. In the numerator, you have EBIT and depreciation. That divided by interest plus any principal repayment, any amount of principal that needs to be repaid. So fixed charges coverage ratio is EBIT plus the depreciation divided by interest and the principal repayment. So this is what the cash you have. This is the operating income which you have generated. With that, are you capable to pay the interest and the principal? That is what we are looking at in the fixed charges coverage ratio. Okay. Okay. So for fixed charges coverage ratio, we consider the cash income in the numerator. Then there's another ratio similar to fixed charge, which is even more accurate. Debt service coverage ratio. In the debt service coverage ratio, we write it as earnings available for debt service, earnings available for debt service divided by interest plus principal repayment. This is also similar, but the numerator is even more specific over here. Earnings available for debt service. Now, what is this earnings available for debt service? Earnings available for debt service is, guys, you compute the profit after tax, that is after payment of tax, whatever income you have, add back non-cash expenses, add back interest, and plus or minus non-operating items. So add back, add or less the non-operating items. Okay. So here we have this debt service coverage ratio on which the numerator part, it tells you how much income you have, how much cash you have to pay interest and principal after excluding all those non-operating. See, non-operating income which you might have earned, that is not sustainable, because the non-operating income may be just paid off, right? The non-operating income may be removed, or that is not sustainable. One fine year you may have some gain on sale of fixed asset or gain on sale of building, but that gain on sale of building is not sustainable. That will be, getting reverted. That's not going to happen every year. And for that reason, you need to add back all those non-operating items, add back the interest, and add back the non-cash expenses. Okay, so PAT, add back the non-cash expenses, add back the interest, and adjust the non-operating item. This is even more specific. So which coverage ratio is practically used, sir? It is obviously this debt service coverage ratio because of its wider application and also more detailed understanding of whether the company is in a position to honor its debt obligations. Okay, so these are the four coverage ratios that we have, right? I hope these four coverage ratios are understood by you all. Uh, Non-operating item, see, if it's a non-operating expense, you need to add it back. If it's a non-operating income, you need to remove from the PAT, right? That's as simple as that. The non-operating income needs to be reduced, non-operating expense needs to be added back. Okay, great. Fine. Now, let's go for the next concept. So, along with short-term and long-term solvency, uh, we need to check efficiency of company. How do we check whether a company is performing efficiently or not? Let me just take you a simple case, X and Y. X has got a sales of 1 lakh. Y is having also a sales of 1 lakh. So just by looking at the sales figure, you cannot say which company is more efficient. If I tell you that company X employs asset of 50,000 and company Y is having an asset of 20,000. So with the asset of 50,000, company X is able to generate 1 lakh sales. With the asset of 20,000, company Y is able to generate a sales of 1 lakh. Out of these two companies, tell me which one is more efficient, which one is more efficiently utilizing its resources, which company is utilizing its resources in a more efficient manner. Tell me, guys. Why is better? Perfect. Yes. So we'll simply say that X generates sales sales is 2 times of total assets, whereas for Y, the sales is 5 times of total assets. Right? So for company X, the sales is 2 times of total assets. For company Y, sales is 5 times of total assets. So with just 20,000 assets, Y is able to generate the same sales which X is generating with 50,000 assets. Right? So this company has got low efficiency and this company has got high efficiency. Low efficiency and high efficiency, and rather we can say activity ratios for company X is less active, whereas company Y is more active, right? So X and Y are having a level of low efficiency and high efficiency, and they're having like less active and more active. Now, similar ratios we have to measure these measure the efficiency from different perspectives. So you check efficiency with respect to the level of assets that you have, with respect to the level of fixed assets that you have, with respect to the capital or again the net asset that you have. So here we say total asset turnover ratio. Total asset turnover ratio. It indicates how efficiently utilizing overall assets. That's going to be like sales upon total assets, which is equal to COGS upon total assets, right? Then you have the fixed asset turnover ratio. Now depends which ratio, sir. Should I use sales or should I use COGS? That depends on the question, the formula that is being asked to you. The question is going to specify you whether you need to use sales or COGS. If nothing is specified, you're supposed to be using sales. Fixed asset turnover ratio is going to be like sales upon the amount of fixed assets, or it is going to be COGS upon the fixed assets. So this ratio indicates how efficiently you are utilizing the fixed assets. This ratio indicates how efficiently utilizing the total assets. Then next is capital turnover ratio. So capital turnover ratio will be sales upon the net asset, or you can say sales upon total capital employed. This is going to be also COGS upon net assets, or it is COGS upon total capital employed. Right? So that's your capital turnover ratio. Then we have how efficiently you're utilizing the current assets. For that, we have the current assets turnover. Current assets turnover is sales upon current assets, or you can say it is COGS upon current assets. Working capital turnover, it indicates how efficiently you're utilizing the working capital, which is sales divided by working capital, or COGS divided by working capital. Right? So that's your working capital turnover ratio. Okay, so all these ratios are activity ratios or efficiency ratios. So all these ratios are activity ratios. Correct? So all the ratios that we have are the activity ratios. Fine. Now, we need to look at some specialized turnover ratios with a detailed understanding of what those ratios mean. Okay. So let's look at three more turnover ratios which have got a in-depth interpretation, which is inventory. First one is inventory or stock turnover. inventory or stock turnover ratio, which is COGS divided by average stock, right? Now, of course, the point over here is how do we get the average stock? Average stock will be opening stock plus closing stock divided by 2. Average stock will be opening stock plus closing stock divided by 2. That's for average stock, and in the numerator you'll have COGS. Now, before I go proceed further, there are any queries? In study material, it is given that the a firm whose plant and machinery are old may show a higher fixed asset turnover ratio. If plant and machineries are old, Darshan, if plant and machinery is old, then fixed assets are getting old. So from the fixed assets, you won't be able to generate, quality products, and for that reason, sales will go down. So your sales will go down. As the sales will go down, fixed asset turnover ratio will be low, right? What's the difference between net asset and total assets? Net assets is the fixed asset plus current asset minus current liability. Whereas in case of total assets, it includes all your assets. Current asset is not subtracted for total assets. Okay. Then now let's come to this ratio, an important ratio of inventory turnover ratio, inventory or the stock turnover ratio. Uh, so the inventory or the stock turnover ratio is COGS upon average stock. Let's understand what does this uh, mean. Now, of course, you can also take the sales upon average stock. But the idea is in the denominator, when you have the stock is measured at cost. So if it is measured at cost in the numerator also, it has to be something which is representing cost. I cannot include sales. And if the question is silent about COGS, then you can use sales. However, if the question is, specifically giving you information about COGS, you should be using this thing because the level of figures should match. COGS is cost and even average stock is also cost. So that needs to be divided to get the inventory or stock turnover. Okay. Now let's understand this ratio in a bit detail. Suppose cost of goods sold is 12 lakh and the average stock that you maintain in your books, average stock that you maintain is 3 lakh, right? So if I tell you how many times of stock is your COGS, how many times of stock is your COGS? Can you tell me? Your COGS is how many times of the average stock? Can I say it is 4 times? Correct? Because your average stock is 3 lakh, whereas the COGS is 12 lakh. It means you're keeping a stock of 3 lakh on an average, and over a period, over the full year, you are selling 12 lakh worth of goods. So basically, you are maintaining stock, or I can say your COGS is 4 times of the average stock, right? So if I tell you inventory turnover of this company X is 4 times. If there is another company Y which has got inventory turnover as 8 times, can you tell me out of these two companies, out of these two X and Y, which one is more efficiently utilizing its stock? Which of them is more efficiently performing its business function? It is Y, right? Because Y is able to generate sales which is 8 times, or it is able to sell goods which are worth 8 times of the stock that it holds. right? Right. The Y is supposed to be more efficient. So here we can say high inventory turnover indicates a higher inventory turnover. What does it indicate? A high efficiency, high efficiency in selling, right? So if I ask you what's the inventory turnover ratio formula? So inventory turnover ratio formula is what we have already stated. It is COGS upon average stock, right? Now, taking it a bit more ahead, if I tell you that inventory turnover is 4 times in a year, right? Inventory turnover is, let's say, 4 times in a year. It means one lot of goods is going to be sold 4 times in a year. So, for example, you have this inventory, it gets sold gradually, right? And then again, you purchase the inventory. Again, it gets sold gradually. Then again, you make a purchase. That again gets sold gradually. So, in this way, we are going to have a cycle of 4 times. 1, 2, 3, 4. So, 4 cycles. We have 1, 2, 3, 4. Right? So, there are 4 cycles. This is like you begin over here 0, and this is like 12 months. So, in a full year of 12 months, you are going to have an inventory turnover of 4 times. So, it means the stock that you maintain, that is equal to 1/4 of the entire full year sales. So your sales is essentially 4 times of your average stock. Sales is essentially 4 times of your average stock. So if inventory turnover is 4 times, now looking at this chart, can you guys just tell me in how many months, would one lot of stock be sold? In how many months would one lot of stock be sold? Tell me. If inventory turnover is 4 times, in how many months would one lot of stock be sold? In how many months, guys? 3 months, right? Because when you look at it over here, it's like 3, 6, 9, and 12. And this number of months in which you are going to sell the stock is called as stock holding period. That's called as stock holding period. So how did we compute this 3 months stock holding period? We got this as 12 months upon stock turnover, which is 12 divided by 4, which is 3 months. Right? So stock divided by, again, the 12 divided by the stock turnover ratio, that is 3 months. The stock holding period is 3 months. So for every 3 months, we have, for each of those 3 months, we have that criteria that one lot of stock gets sold basically. Okay. Now, if the question asks you, what is raw material inventory turnover? raw material inventory turnover. You will not take COGS, rather you will take raw material consumed upon average raw material stock. Okay, so that's your inventory turnover, which tells you in how many times in a year you're going to sell the, or I can say you're going to sell, in how many months you're going to sell the one lot of goods. Now, one question to you. Here we had it as a 3 months when it was 4 months. What will be the case if you are having it in 8 times? If your inventory turnover is 8 times, if your inventory turnover is 8 times, is the stock holding period going to be greater than 3 months or lesser than 3 months? Greater than 3 months or lesser than 3 months? Yeah, it is definitely going to be lesser than 3 months, which I can show you with a calculation. 12 divided by 8, which is 1.5 months. So if you are selling the goods at a faster pace, you'll be holding the inventory for a lesser number of period, right? You'll be holding the inventory for a lesser number of period, right? So that's what we say. So high activity means high inventory turnover, and it also means low. It also means low inventory holding period. Low inventory holding period. So high activity means high inventory turnover and also low inventory holding period. Okay. Now, similar turnover ratios, we can have it for receivable turnover. Receivable turnover is simply credit sales upon average accounts receivable. Receivables turnover is credit sales upon average accounts receivable. And remember that this average accounts receivable is essentially average debtors plus average creditors. Now, how to get average debtors? Average debtors is like opening debtors plus closing debtors divided by 2, and average creditors is opening creditors plus closing creditors divided by 2, right? So receivables turnover. So let's say I'll tell you credit sales is suppose 24 lakhs, and you have average debtors as 8 lakh. Now, if I ask you receivables turnover number over here, that will be 24 lakhs divided by 8 lakh, which is 3 times. 3 times. Now, what does this 3 times means? This means sales is 3 times of its debtors. Sales is basically 3 times its debtors. So whatever sales you're making, that is 3 times of the debtors. Okay, so if there is this 3 times and there is another company, let's say company Y, which has got 8 lakh debtors, but with a sales of 80 lakh, which is 10 times. So here it means sales is 10 times of its debtors. Sales is 10 times of its debtors. So now tell me, out of these two companies, X and Y, which one is more efficient in collecting money from the debtors? Which one is more efficient in collecting money from the debtors? Of course, it is Y, because you are able to sell again and again and get the money collected from the debtors. So on a similar lines, just as we had inventory holding period, same way we have the debtors collection period. Debtors collection period is 12 months divided by the receivable turnover. So in our case, it is 12 divided by 3, which is 4 times. And for Y, it is 12 divided by 10, which is 1.2 times. Right? So that's your, you know, receivables turnover ratio. My bad, 1 second. This is not times, this is months. So this is 4 months and 1.2 months. You can say high debtors turnover indicate low debtors collection, which is indicating greater collection efficiency. Okay. On the similar lines, all the turnover ratios are yes in times only. On the similar lines, we have another ratio called as creditors turnover ratio or creditors collection. So creditors turnover, you'll be able to tell this that it should be simply net credit purchases upon average accounts payable, right? And then it is like if you want the creditors payment period, that is 12 divided by 12 divided by creditors turnover. Okay, so these are your turnover ratios which I wanted to discuss for the day. So with that, we'll be closing our session. If there are any queries, you can ask me. I'll wait for the next couple of minutes. Because the next set of ratios that we have with regards to profitability and market ratios, those we are going to discuss in the next class. As of now, I'll just stop my discussion over here. Just waiting for the queries. If you have any, I'll address them, or else we'll call it a day. Are there any queries? Why debtors turnover ratio includes creditors also? No, debtors turnover ratio is different. Creditors turnover is different. What is credit and investment advisory service? That's a service altogether, Malvika, that you undertake some sort of credit, uh, credit appraisal or calculate the credit rating of a company. And investment advisory service is like advising your clients as to which areas of investment should be chosen. Is the angel investing the same as venture capital financing? No, angel investing is different and venture capital is different. Angel investing happens at a smaller level. Venture capital happens at a larger level. All clear? Okay, guys. So with that, let's just stop here for the day. See you in the Monday's class.